Welcome everyone. My name is Kamal Manocha. I represent PMS AIF World platform. First of all, warm welcome to all of you. And also, I would like to apologize for whatever happened on Friday. We were to do a webinar as planned at 5:30, but because of a technical glitch, we could not do that. But it kind of, comments that we received were quite encouraging from some of our loyal subscribers, and that actually encouraged us to quickly plan this webinar. And here we are to kind of, perform whatever we planned today at 4:30. It's a very interesting and very intuitive webinar because through this webinar we are trying to actually learn something which is a new phase of equity markets in front of us. For last, I would say, more than 4 or 5 years, we have been talking philosophically a lot about some of the secular businesses. So we have kind of understood about things like Asian Paints, Bajaj Finance, HDFC Bank, TCS. All these are good businesses, and philosophically some of the best companies for their respective products. If today I had to get a paints product purchase for myself at my house or my office, obviously I would go for Asian Paints. Similarly, I will get my bank account open with HDFC Bank. And likewise, all these names which I took are some of the best names when it comes to I seeing them philosophically as a consumer. However, when I wear a hat of an investor, especially in the growing phase of economy, like which is in front of us over the next 5 years, one has to be definitely cognizant about valuations, and not only just valuations, but the growth in earnings, because these are the two factors which actually lead to the re-rating of a stock and ultimately rise in the price of a stock. In that context, exactly today, we want to understand from Mr. Anup Maheshwari, who is CIO with IIFL AMC for last 4 years and brings with him more than 2.5 decades of experience, particularly in equities, that what are the turnaround equity opportunities in the current context and how to spot those turnaround equity opportunities. We have, as I said, I reiterate, we see that some of these good companies, which we call as quality stocks, kind of fallen over last 8-9 months of correction. On one side, we have a choice of investing in these companies, but on the other side, if we learn that what are the turnaround business opportunities, in the sense that those businesses which are getting into the phase of they actually becoming tomorrow's secular businesses, how to identify that, what are those businesses, is exactly what we want to learn through this webinar. Over to you, Anup. A warm welcome to you. Before we begin, I would like you to kind of give your views and perspective on the theme of third turnaround opportunities. Over to you.
Sure. Thanks so much, Kamal, and very warm welcome to everyone. And and let me just add to Kamal's apology. I think there was some technical issue. We tried a lot, but finally we had to give up because it was just taking too long to get online. But really happy to see whoever is taking the effort to come again. Very quickly, just on the turnaround fund. So this is something we actually conceived of at the start of last year, 2021. And this was, just to put it in context, that was the time we had come out of COVID in a way. Things were normalizing. The vaccine had been found in October 2020. And we did feel that, we are in for a situation where there are a lot of companies whose profitability was impacted in the short run, but there would be a resumption of normal activity that would come through. And in that sense, there were a lot of these potential turnaround opportunities that existed. So these tend to happen in a cycle where, from a very low base, the economy is starting to grow again. That's at a more macro level, but there are a lot of micro level details as well in terms of opportunities linked to, let's say, management changes, or a particular company that has gone through a rough patch for very company specific factors but can come back. So we found a lot of such opportunities at that point in time that were presenting itself both top down, bottom up. And we felt, it definitely was a fund worth putting into the market in terms of its value creation capability. And I'm glad to say that, it's been a year and I think 3 months or so since the time we were able to launch that in a PMS format. And now, of course, it's also in an AIF format called Turnaround Fund. And it's sort of pretty much doing what it was supposed to do, and has been performing fairly decently. So that's a quick background. But as we go through the Q&A, I can probably explain to you some more details of how we actually select these names.
Sure. Right, Anup. So the first question as an investor, if I put myself in investor shoe, comes to my mind is that today I see auto as a sector kind of showing trends of turnaround. I also see ITC as a stock showing as a signs of turnaround. Can you take few examples of a sector or a stock likewise, maybe in the past or maybe in your expected portfolio to explain the entire context of turnaround opportunities?
Sure. So the basic concept, that we're looking for from a pure fundamental standpoint is that we're looking for companies who have the business ability or the economics in their business to deliver a certain return on equity or return on capital employed, but are currently actually delivering a much lower number than that. And therefore, the market is not necessarily paying them the right price for that economics that they are capable of delivering. Typically, if you can see a path to those economics coming through over the next 2 or 3 years, you get a combination of earnings growth as well as a valuation re-rating kicking in as people start adjusting to that higher ROE or ROC, which is really the core ROE, ROC of a business. So typically, we're always looking at companies who in the past have delivered a certain ROE or ROC. Their business is capable of delivering a certain economics. And for some reason or the other, today it is actually significantly below that. This is actually, in a way, the error the market also makes, which is, and that's what we have to try and use to our advantage. The market tends to look at the coming year ROE of a business and assumes pretty much like a DCF that is the ROE to perpetuity. Okay, I'll give you a very extreme example of the most extreme movements that we see in turnarounds come largely in cyclicals, let's say metals, for instance, as a sector. Now you notice something like Tata Steel, Hindalco, when they go through a bad phase, they tend to go down to 1/3 to half book value. And that's where they tend to bottom out. Because what is the market doing? So typically the market is looking at the coming ROE of the business. Let's say in a bad down cycle, we all know that these capital intensive businesses, their profits just evaporate. If in a poor economic cycle, if your plant is not operating and you have very high fixed overheads, the impact is straight on your profits. And ROEs, they could make a loss or the ROE could be early single digits. Now, what does the market do? The market looks at that ROE and assumes that ROE is there to perpetuity. And if that ROE doesn't even cover interest rates or the cost of capital, then forget about trading at net worth. These businesses should be valued even below the net worth, which is below book value effectively. And they go to 1/3 book value. Now, obviously, that's not, if that was the core economics, Tata Steel, Hindalco would have shut shop and stop doing business. What's the point in running a business if you can make more money from fixed income with that capital? So the reason they stay in business is that there is a cycle that will come at some stage, an up cycle. And in an up cycle, it's the exact reverse. Now your plants are operating at full capacity, you get massive operating leverage, and your ROE goes from maybe a loss or single digit to maybe 15 or 20%. And at that point, what will the market do? The market will assume 15% ROE will go on to perpetuity. And suddenly these stocks will be trading at 2x price to book. So you've gone from a 1/3 price to book to 2x price to book with just a small shift in the economic cycle and a resumption to normalcy. Now, the market will move to both extremes because it's just looking at that ROE. Now, in the longer term, you'll have some good years, bad years. And overall, as long as Tata Steel covers cost of capital in a bit, it's worth doing that business. And that's the sort of shareholder value they might create over long periods of time. But in between, there's a lot of this volatility around the ROE. And that's really what we're trying to capture. So I've given you the most extreme example, but there are a number of similar cases. There's one company called SRF, for instance. We all are familiar with SRF. SRF, used to, at some point in time, contribute a lot negatively to the environment. They started shutting down capacities, and for that they were given carbon credits. With that carbon credit, so they had a very traditional business of technical textiles and packaging, which was very commodity-like, and they had this big cash flow coming from carbon credits. They deployed all that carbon credit cash flow into their specialty chemicals business that eventually and now has created a lot of value for them. But when they were going through that deployment phase, wherein they were investing in the Dahej facility and there was no economic return coming on it, SRF was trading close to book value at that point in time because people couldn't see any ROE or any return on that investment. But the fact is, the capital was going into a business that has very good economics. And as that plant ramped up eventually and the economics have come through, you suddenly have SRF trading at 5-6 times price to book. The same thing for Bajaj Finance, which we all talk about. It's been one of the best performers. Go back to 2007, Bajaj Finance was trading at half book value. Their ROE was single digit. In fact, they made a loss in one of the quarters, just around the global financial crisis. They were only doing two-wheeler financing largely. They had not even started a consumer finance business. It only started in full earnest when Rajiv Jain came in. That's what we'd call a turnaround, right? There's a management shift. Somebody's come in, suddenly the business profile begins to shift. ROEs move from single digit towards 20%, and the price to book re-rates massively. In this case, it re-rated much more than any of us would have thought. But it went from literally half book value to multiple, initially to 3-4 times price to book, and now of course to 8 times price to book. So those are the shifts that you're looking for. You're looking for businesses that, for whatever reason, are being underpriced today relative to what ROE they're capable of doing. And you have to keep looking for catalysts for that ROE to be able to come through over the course of the next few years, and then capture the combination of the earnings growth and the re-rating. That's very, very powerful. When you're capturing both, if you're buying a business that's already well discovered and is expensive, then you're buying the earnings growth incrementally, and you're maybe taking a bit of a risk on valuations. Here, you're getting the combination ideally of capturing the earnings growth and the valuation re-rating that actually makes the multiplier effect very dramatic. So that's the whole idea. You have to just make sure you get them more right than wrong, basically.
Sure. So, again, trying to think from investors' perspective, especially over last 5 years when we have seen consumer discretionary doing quite well, some of the highly priced businesses, some of the names which I took kind of delivered very well. For example, HDFC Bank, Asian Paints, Titan, all. So the portfolio, which is outcome of these turnaround, is something which is totally diagonally opposite of some of these companies. Like, for example, in banking, you would have stocks like SBI, Axis Bank, and ICICI Bank versus an HDFC Bank. Similarly, your allocation to IT, the sector is quite low. Or, within IT, if you have stocks, your stocks could be like Cyient or Persistent Systems, right? Versus maybe, a normal common investor having invested most money in stocks like Infosys or TCS, right? So actually, it is difficult to build conviction for a turnaround portfolio. But I agree, this is a learning phase, and investors would maybe get to know and understand about this changing phase where markets have become more value conscious, over a period of time. And that is where the rise in the price will ultimately change the perception. But how to put that conviction today, when investors are actually kind of too much biased and too much, I would say, overweight in some of the highly priced stocks?
Yeah, Kamal, just to put some perspective on that, it doesn't mean for all you may get opportunities in some of those names also. Every good business also goes through a rough patch. The definition for us is if the valuations are below what they normally are. What you don't want to pay is an above average valuation. So let's say, I'm just picking up a very random name, but let's say in the paint sector, there's a Kansai Nerolac, right? Which is obviously been going through a much rougher time than an Asian Paints. It's in the paints business, but it's also linked to the auto sector. And even on the decorative side, they haven't done particularly well. So that's been derating even before the Soul Paints derating started a little bit. But if you get a combination where the sector is under a little bit of stress because of more players coming in, plus very specific to a company, there's this factor, and the valuations come to the bottom end of their range, and that finally longer term this is a decent business. It might be a short term thing, but it's not as easy for new players to just come in. That presents a turnaround situation. It could be also for Asian Paints, as the valuations came off to a certain point. So it's all it's not that you cannot own any of these names. You can if they're good businesses but it requires them to have gone through a rough patch, which forces the valuation down to giving you a much higher margin of safety. Let me put it that way. So one of the positions we bought when we started this fund was Blue Dart. So what was the story of Blue Dart? Blue Dart has been around for 25, 30 years. Blue Dart historically was a very consistent 20% ROE business. When you go back in time, right from the 90s, it was a consistent 20% ROE business. And the market re-rated it massively in 2005, 6, 7. And then it went through a huge derating. Blue Dart, nobody ever thought would derate. It went from 8,000 to 2,000 rupees over the course of the next 6, 7 years. I mean, not even a slow derating, fast derating, a very slow sort of derating that kept happening because their ROEs came off a lot. And when we saw a situation where things were changing, the ROEs could potentially go back up. We felt that was a very interesting opportunity, and we invested into it at the start of this fund. And that's a typical. So it's a good company that had gone through a rough patch. Valuations were more in favor, and ROEs were below what the core business capability is. And that's where the opportunity presented itself. I'll just add one more thing. When you look at re-ratings as a concept, the maximum re-ratings you actually get, if you go back and test it out, is when ROEs move from 10 to 15%. That's a very, very important threshold of re-rating. Not necessarily when an ROE is moving from 35 to 40% or 35 to 45%. You may not get as much of a re-rating there as the re-rating you get when an ROE is moving from single digit or 10% towards 15%. That's where stocks move from below book value to premium to book value, or a much higher price to book. And that's where you get big re-ratings, and typically there's obviously earnings with it, otherwise that ROE won't happen. So, we keep looking at scenarios like that, where our companies have a 50% plus ROE capability, but for whatever reasons, they're below that today. The price is also reflecting that. Valuations are below average, but these are good quality companies. They clear all the forensic and governance checks. We're not going to buy rubbish companies just because they're available at cheap price to book. So there has to be a quality orientation in the portfolio. These criteria should have been met. The price should be down. There should ideally be some sort of catalyst for us to believe that the ROE can move up. It could be a management change. It could be just a business cycle. And when you put it all together, that's where it points in our favor. And then we keep a very close eye on things like insider buying activity. Typically that also gives you a bit of an indicator that you've hit the bottom. So things like that, a lot of things go together to produce these ideas.
Sure. So Anup, would you have any slide to kind of share with us, which kind of talks about all this, maybe point wise or in a form of a process or a checklist?
Sure, I have one slide. Maybe let me just pull that up. Yeah, so this is, so these are the very simple 7 criteria we use. One is, we have this format called SCTB, that's our investment framework, where S stands for secular companies, C for cyclicals, D for defenses, and V for value traps. And what we're looking at are businesses whose economics are moving from a lower quadrant to a higher quadrant, which means ROEs are moving upwards or profit growth is moving upwards. So that's first criteria. Second is that currently the profitability is actually lower than historical trends. Otherwise, you will not get the price in your favor. Per force, the business has to be not doing well today for it to fit here. But at the same time, they should have, point number 3, a past track record of capital efficiency and the ability to have delivered an ROE of greater than 15%. If they've never done that, we're not interested in these companies or businesses. The fourth one is they should be trading at a discount to the historical valuation, so that increases your margin of safety, and it's bound to happen if profitability is anyway lower. We look for catalysts like changes in management and ownership, point number 5. Those could be dramatic. I mean, we've seen, as I mentioned, Bajaj Finance being a case in point, or Varun Berry and Britannia, or Pratik Pota and Jubilant Foodworks, or Ramesh Sokte in IndusInd Bank. I mean, there are enough reasons of these changes. If you just catch those changes at the right time, there's big value capture that tends to happen, and the ROEs tend to follow. Point number 6, very critical. So we no compromise on quality here. They have to pass whatever forensic checks we do. We have 8 criteria for forensics. and governance should be strong. We don't want to go into poorly governed companies. And finally, stocks where the price correction has occurred. So these are not necessarily at 52-week high type of moves. These are, reasonably below where they've traded in the past, and they can go back to those price points. So it's very simple. And then, as I said, we superimpose a few other things. If there's also insider buying activity, or it's sort of reached a point where volumes have reached a very low level, institutional ownership, there's been some change there. We can take a look and see if the right thing comes our way. But these are the broad 7 criteria that we use. Maybe I'll just stop sharing.
Right, Anup. So as you mentioned in the beginning that turnaround opportunities was launched first as a PMS and now as an AIF, but actually it was conceptualized more than 1 year ago. And a lot of things in equity markets have actually changed in last 1 year in terms of the rise in interest rates, the rise in inflation, depreciation of currency. So all these macro factors, do they impact this conceptualization or they favor this conceptualization? And how does that change in the mix of sectors in terms of attractiveness from the context of turnaround opportunities is impacted by the change in the scenario over the last 1 year? Would you like to cover this?
Yeah. So these type of conditions are actually perfect, frankly, for turnaround, sort of this type of a fund. So what you're looking for typically, as I said, is, so first of all, there are always some turnaround somewhere or the other. The businesses that go through their own cycles for internal reasons, external reasons. So there's always something to find. It's just how many ideas can you find at a point in time? You tend to find more ideas in these type of conditions. And in all-out bull markets, those type of ideas keep diminishing because you don't have that margin of safety and whatnot. So this is, in that sense, a good product in uncertain times because it'll just present to you a number of companies that it broadens your investment horizon or universe a bit. Of course, we still have to get it right. That's most important. But if you go into an all-out bull market, then everything starts getting re-rated. And we've seen in all-out bull markets, we look back at 2007, we look back at various points. The ultimate indicator when the whole market is expensive is when less than single digit of the total listed companies. So we normally have 4,000 to 5,000 listed companies. If you go through the last 15 years on average, when less than 10% of them are trading below book value, more like 6 to 7%, that's when actually market tops also tend to occur. So that's where we'll probably have run out of ideas. We'll be just playing off our earlier ideas to a point and running them on. But the probability of finding new ideas would be very low. So I think these sort of conditions are actually good. It's wherever there is some turmoil, that's where opportunities will present themselves.
What are your views on the auto sector? At present, we see a lot price action happening, and there is a lot resistance seen by this sector, especially during the recent correction. So do you see this sector from the perspective of it being a turnaround opportunity?
Yeah, and it's been playing through also, in the sense that obviously good sector, but it's also going through a lot of top-down change as a sector. But more importantly, I think what really messed up the numbers across the entire system was just the whole demand-supply mismatch. You want to buy a car today, you just have nothing available, and you got to wait 3-6 months for the specific car you want to buy. I think all of that will change very rapidly. In fact, we are moving very quickly to the other side where you'll probably have a semiconductor glut coming through from scarcity because everybody's ended up over ordering, and now when it comes through, so suddenly you'll see these big backlogs beginning to get, you'll see very strong numbers at the retail end that will come through. Market's very smart, so market is already anticipating some of that, and you will see that therefore in the price movement accordingly. But yeah, I would say autos to the extent that the core ROE of some of these companies is higher than what is being reported today, and the valuations are still in some cases below average or below normal. That definitely presents opportunities in that sector. So that is in a way a sector going through a turnaround. Correct.
Sure. To audience out here, I would just like to give one disclaimer that we might be, taking names of few companies, they should not be construed as any kind of advice. It's only for the matter of understanding that we are talking some of these names to
Yes.
understand the turnaround opportunities. And in that context, Anup, I would want you to explain how is, for example, an ICICI Bank a turnaround opportunity, because this is one of the top 10 holdings in your portfolio.
Sure.
And to understand the context of turnaround opportunities further, I want you to use this example.
Sure, Kamal. And let me just reiterate that point Kamal made. It's very important. A lot of the names we're giving are examples. We may or may not hold them. Just please apply all the relevant disclaimers around it. So on ICICI Bank specifically, just to explain this point again, at the time that we bought ICICI Bank, the ROE was more like single digit actually, and it was across the banking sector. Most of the corporate related banks had gone through the whole cycle of writing off a lot of their bad loans, and credit costs were high. So what we've seen since then, obviously, is that we've gone to the other end of the cycle now. All that cleanup has occurred. Pre-provision operating profits have been steady, but credit costs now are declining big time, which goes straight to your ROA and your ROE. So we were looking at ICICI's ROE moving from 10% to 15%, which already it's on that journey. In the last quarter, they've already reported at a quarter level of 15% ROE, and they will show that in their annual numbers as well. So you're migrating from 10 to 15% ROE. Price to book, to our mind, is still relatively low compared to where they should normally trade at. If you adjust for all of the subsidiaries, ICICI Bank in that sense, to our mind at least, is still trading below its median price to book. And the combination of the fact that these ROEs are sustainable, there should be some decent growth, and as interest rates rise, that cycle should also play out positively, should help. The fact also for most of these corporate banks now is that more than half of it has become retail in some ways, for most of them. And therefore, there's more stability in the business going forward as well. So, it's a typical case. ICICI fit most of those criteria that I showed you earlier. There was also a management change. Of course, that happened much earlier, and we've owned that name in our other funds even before that. So there was the management change, there was the ROE profile change, there was the valuation being lower than normal. The stock had corrected at that point in time. So it sort of met the criteria. Now, we're still going to hold on to it till we see the valuations go above average, at which point in time you've captured the value of the ROE change and the re-rating and the growth along with that. And then we have to take a call. But essentially, that's the journey that we want to be part of.
Right. Over my last 2 decades of experience, what I have seen, equity market goes through phases where in some phase there is a growth style of investing which actually becomes very attractive. In some other phase, value style of investing becomes attractive. And obviously it is determined by perceptions and liquidity and macro factors. In the current context, it seems to me that market is again going back to the value style of investing because there is a value consciousness around the fact that liquidity is reducing because interest rates are rising, and that favors turnaround opportunities fund because turnaround opportunity basically emerges from a company which is relatively available at a lower valuation. So that is how I am understanding. But how long will this phase last? And in a market, in an economy, where there are uncertainties, if we get into that phase where markets are polarized and there are few secular businesses which become all the more again attractive in that uncertain and risk averse environment, then some of these value picks tend to take time to outperform. Though conceptually, from the point of view of investment sense, these turnaround opportunities are definitely attractive. But hand on your heart, if you are in investors' place, how will you see next 4 or 5 years in the context of this fund?
So, Kamal, I just want to differentiate this a little bit from your earlier comments. This is not just a growth versus value discussion, and it's a bit of a, one shouldn't bucket them into those two extremes. There's a lot in between also. There are enough companies that with rising ROE can grow and are available at reasonable valuations. And that's the space that you're sort of aiming for. You're not buying value just because it's value. You're not buying cheap just because it's cheap. You need those catalysts. So you are looking for a secular resumption of that business as the capture of the re-rating. Without that happening, there's no point. I mean, we wouldn't buy a lot of businesses that are cheap if we don't believe there is a reason for them to re-rate at all. So I just want to, it's not just we're going to look at everything that is value, not necessarily. And value is also relative to historic value. So let's say if I'm buying an FMCG company, I'm not going to get it at, 15p or something in terms of conventional value. But for me, value is, or the reasonable price is that there is a margin of safety. It's trading below its long-term average or something like that. I'm not buying it at least at the upper end of its historic valuation range. So that's just to put that in context. It, as I said, something like Blue Dart is not cheap, but it was relative to its history reasonably priced. We could see the delta, and therefore we bought into it. So that's the context. Now, how long these will continue, as I said, during uncertain times, and we've noticed in all sorts of market conditions, there is some business or the other that is going through some challenge, internal or external. And we have to keep looking. So you just have to keep looking constantly for names like that. So in that sense, it's you're sort of you're digging for ideas, looking for catalysts, which can transmit into above average returns. That's the difference. Rather than a pure buy hold type of, let's just buy a bunch of high quality businesses, not bother what price we're paying for it, and hold it in over time. They will cover up for it. That is definitely not the approach. Here you're trying to leverage off these undervaluations or valuations, but in decent businesses. Having said all of that, so we're not going to go, into deep value just for the sake of value, for instance. So I just want to make that differentiation. Now, how long? I think the strategy has a lot of legs, frankly. It's only in an all-out bull market where suddenly everything is re-rated, most things are trading above average valuations. That's where you would say now there's very limited margin of safety, and these type of, you're not going to find turnaround opportunities. And to that extent, the universe would shrink considerably. That's the point where maybe we'll have to think about it again.
Sure. So IIFL, for last more than 5-6 years has been very successfully running another PMS, which follows SCTB Framework. Where, just to recap for the audience, S stands for secular businesses, C stands for cyclical businesses, and D stands for defensives, and V stands for value traps. And to my mind, to my again understanding, again this was mentioned by one of the clients also, that turnaround opportunities basically would mean that some of those businesses which are more coming from cyclicals and value traps, and maybe less from seculars and defensives. Is that right?
Yeah. So I'm just sharing my screen again. So this is the framework that Kamal was referring to, our SCTB framework, and the essential concept is that what we believe is that return on equity and profit after tax growth are probably the two most economic indicators of shareholder value creation. It's incredibly rare that a company with a rising return on equity and high profit growth will not re-rate or will not create shareholder value. So we sort of plotted X and Y axis with these two variables. And then we've used 15% as a midpoint, because 15% is the normal or average economics of doing business in India as represented by the Sensex companies. So Sensex, we had the longest history of 40 years. So we said, what is the median ROE? What is the median PAT growth? And it was in this range of 13, 14, 15%. So we use that as par for the course. And then we look at companies. So this is done at a company level. We just aggregated it to sectors here. But at a company level, you look back over the last 10 years and look at ROE and earnings growth. And depending on where they fall, you will sort of put them into one of these four quadrants. Seculars being the businesses that have delivered north of 15% ROE and north of 15% profit growth more consistently. Value traps being the opposite, and defensives and cyclicals, relative. So what we do normally in our regular funds, including the multi-cap PMS, is we are always overweight on seculars, underweight on value traps. And here's where we understand that there are cycles, business cycles. When the economy is doing well, you're likely to create more ROE delta and re-rating over here. When the economy is not doing well, you're likely to create more re-rating over here. But these will keep moving from one to the other. And that's where we maintain flexibility in our portfolio so that we're not stuck on one side or the other of these four quadrants. Now what Phoenix is doing is actually trying to go one step a little ahead in trying to anticipate moves within these quadrants. So we're trying to anticipate some companies which are here which can migrate to the right hand side. So get to that 15% ROE. They're currently below. They can get to 15% ROE and above. And that is a re-rating. Whenever anything moves from one quadrant left to the right, you get the re-rating as well as the earnings growth that comes along with that re-rate, that ROE shift. And that's where you make excess returns. And that's what we're trying to capture. So in a way, Phoenix is looking at quadrant upgrades as one of the key criteria in terms of making those investments.
Right. What is the allocation towards PSUs in the turnaround fund or a Phoenix fund? Because I see a lot of PSUs also, which are kind of attractive in terms of management, as well as kind of a potential for re-rating because they are relatively undervalued. But at the same time, I have seen most fund managers kind of say no to PSUs because it is largely perceived as a social good, as a public good, not a business for shareholders value addition. So what are the views in this regards when it comes to a turnaround opportunities fund for this sector?
Yeah, so listen, so public sector companies, I think it's again not necessarily fair to put everybody under one broad brush. There's some really well managed public sector companies as well, which are not as necessarily day-to-day regulated as some of the others, who have the ability to deliver returns based more of a regular market principle. So we're looking at companies, even in so for instance, let's say if there's HPCL in the portfolio, we're looking at the fact that they have the ability to deliver a certain ROE. Obviously, conditions like this might be tough for them, but this is not normal. And at some point in time, this will change. Their ROE capability is definitely higher. They have an infrastructure, they have a network, they're, providing a very essential service, and they have the ability to do it at a better profitability level. And if the market punishes them and they end up trading below book value for whatever reason temporarily, then that's an opportunity, just as an example. So we don't want to brush everything with the same, the same color or whatever. I think, by and large, the history of public sector companies has been intervention by the government. There have been enough cases. So we have to be careful. It's not like it's a blanket buy or a blanket sell either. I think the idea is to look bottom up, look at where the valuation comfort is there, where we believe there's an opportunity for it to change or a mispricing that has occurred, and then participate with it. But is there a number that we define? No. It's not like a conscious thing. This is a very, very bottom-up portfolio. We don't start top-down at all. We're not thinking of, this is the sector weight in the index and this is how much we should have or something like that. It's very, very bottom-up, stock by stock by stock, with those criteria that we mentioned.
Sure. So, being a bottom-up portfolio and where we are trying to understand business from the perspective of it getting potentially re-rated, is the choice of businesses in the portfolio also getting restricted at some level in the context of overall portfolio's outcome in terms of this much percentage goes to large cap, this much goes to mid cap or small cap, or portfolio can end up becoming a large cap biased or a small cap bias, depending upon where you see the possibility of a turnaround.
Yeah. No, the beauty is exactly that, which is it is so bottom up and looking at specific opportunities that everything else is an outcome. The sector allocations are a bottom up outcome. The market cap allocations are a bottom up outcome. There's no predefined number on it. This is truly an expression of looking for bottom up, mispricings that have occurred in businesses that meet quality criteria or forensics criteria, and then participating in that potential turn. And if you just get them more right than wrong, I think there's potential for superior returns because you're capturing the earnings and the re-rating simultaneously. But that's the beauty of the fund, which is there's no top-down structure of saying, I will have this much or minimum of large caps, because you're just looking for wherever the opportunity, whether if it presents itself in large caps, that's great. If it presents itself in a small cap, that's also fine. The good thing we have also on this fund is the fact that the size right now is still relatively small, so it allows you more flexibility across market cap. If the fund became too big at some point in time, then automatically your flexibility will reduce, and by default you would start going up the market cap chain. So this whole strategy, at some point, as I said, if we're in the throes of a bull market, very limited opportunities, or the size becomes bigger than it should be, this is a product that we'd be quite happy, and we've sort of, at least in my earlier avatar also, we've demonstrated that we're quite happy to decide at what points we don't want to take more money, because it's probably not likely to result in enough opportunities for that outcome.
So you mean to say that there is no such a minimum or maximum, limit in terms of market cap in the very first filter when you will kind of start to work on an Excel sheet to kind of reach the ultimate conclusion?
Correct. But by and large, the only rule of thumb that tends to work is that the minimum market cap gets defined by the size of your strategy. So if it's, let's say, 1,000 crore strategy, it's unlikely that you'll go much below 1,000 crores in terms of market cap to invest, because otherwise every 1% you're buying that much percentage of the company or more. So that by default won't allow you to go too far down, maybe in exceptional cases only.
Sure. So, because now you guys have been doing this turnaround identification in terms of opportunities for last 1.5 years, based on your experience, does this portfolio outcome see a concentration towards a particular sector, or it gets fairly diversified across sectors in the sense that there is always an opportunity to find turnaround equities in various sectors? Because to my mind, the first thought that comes is that maybe a sector will turn around, and that is where some of the stocks and businesses will turn around in that sector. But what you are saying that portfolio is very well diversified and this is absolutely bottoms up. However, as an outcome based on your last 1.5 years of experience, do you see that ultimately a portfolio which will be outcome will have a concentration towards certain sectors because those sectors are seeing turnaround?
So in the last year and a half, it's been fairly broad-based. We've been finding enough opportunities across a wide range of sectors. So it's not by default, it's not one sector dominant or anything like that. Again, as I said, we're looking bottom up, so we're finding it across small caps, mid caps, everywhere. So that's been the portfolio experience so far. But if the market gets more narrow and we see maybe one sector being totally mispriced relative to the others, sure, that might happen. But by and large, I think the way we've observed this, and not just in the last year and a half, but just given my experience over the last 25 years, you will tend to find multiple turnarounds in multiple sectors. In any sector, there will be some company that may not be doing well at a point in time, and that presents potentially an opportunity. So, as I said, we're just looking at economics of businesses and the ability of the mispricing between current economics and potential economics, and how much of potential upside there is with that.
Sure. So, would you like to explain the ultimate outcome of the portfolio in terms of average market cap, average valuation, average number of stocks, for an investor to kind of visualize the outcome of the portfolio?
Yeah, so it's difficult to give you an average because that could change over points in time. But I think it's a simpler way to answer this is that the price to book of this portfolio will tend to always be lower than the average price to book of those companies, because that's what we're trying to do. So it will tend to be a slightly lower price to book. It will also tend to be a slightly lower ROE at the time of purchase, with the delta and ROE. So the earnings growth potential, forecast earnings growth has to be higher than the market. ROE delta has to be higher, but at the point of entry, it might be a lower ROE and lower price to book type of mix. In terms of number of companies, also we've kept that unconstrained. I don't want to have some limit prohibiting me from finding a certain idea. So we have around 38 names, I think, in the portfolio at the moment. And somewhere in that range, I think, is a normal range for us. But we've not put any limits, either upper or lower limits in that sense. Obviously, with a fund of this size, it makes no sense to have 60, 70 names. It'll probably be sub 40 for most of the time. But yeah, we've not put a cap, say, or a floor.
Sure. So, this is the second last question that I'm going to ask you, and that is again on a stock, which is one of the again top 10 stocks. So, how is Bharti Airtel a turnaround opportunity in the portfolio? Can you please explain the thesis and
Yeah.
the expectation around that?
Sure. Again, that's a classic case of ROE migrating to 15% and higher. Bharti Airtel, the entire telecom sector over the last decade has been a single-digit ROE sector and a very big value destroyer of shareholder value. And a lot of that originated, Bharti used to actually have decent ROEs in the early 2000s, but then went through this really bad patch regulatorily, the whole crisis, the whole telecom scandal and whatnot from 2007 onwards. So the point is, for Bharti, now that the industry has consolidated, and clearly we are seeing now pricing uh, sort of flexibility coming back into the sector, the desire to increase pricing, their desire to bring economics back on track, and this random capital allocation every year actually reducing. We're clearly seeing a path towards 15% ROE over the course of the next few years. And to the extent that it's still fairly amongst the utilities, a very well managed utility. Its governance and forensics are quite strong. So to that extent, it sort of fit the bill on all these parameters. It's not performed much. It's trading below what its core ROE capability is. It's decent management, meets all the criteria that we're looking for, and therefore it's part of the portfolio. Again, this was bought right at the start of the fund last year.
So another, sector which is seen as maybe a turnaround sector by most other fund managers is real estate. I see currently, many PMSs kind of giving allocations to businesses which are positively impacted by the turnaround of a real estate sector. And because real estate sector is something that we ourselves are consumers of on daily basis, we feel that yes, there is a turnaround. Does this sector, belong to your turnaround equities framework or not, and why?
So the biggest challenge we've come across in real estate is if you look at all the companies there, we haven't seen a 15% ROE happen for almost all of them actually. Even the best managed real estate companies have struggled to get even to a 15% ROE. And that might be just the nature of the business, the fact that you have to run a land bank, there's a certain cycle to all of that. But the fact is, even the best managed companies were struggling in early double-digit ROEs, and therefore it's not a sector that really came naturally to us to invest into. But we have one position which is sort of linked to that sector. It is linked to the sector, which is Century Textiles, where it's a combination of a paper business and a real estate business. The paper business is obviously producing the ROE at the moment, and the real estate business, has the potential for, because it's fairly concentrated business and one project dominant. I think that has the ability to produce a certain ROE. So that is one position that probably was a bit of an exception to this whole trend where we could see potentially an ROE coming through. But in most of the other real estate companies, unfortunately, we've not seen that, and therefore it's a sector we've probably stayed away from.
To audience out here again, I will reiterate that we have been discussing about some of the stocks these are only, as you have seen, for understanding and not to be construed as any kind of an advice. Also, to all of you who have asked some of the product related questions, that what is the lock-in period and all, I would urge you to book a call or book appointment with us. We have experts in our team who will be able to answer to your unique questions. Here we want to cover more in terms of conceptual questions about the thesis of the fund. And Anup, I come to my last question, where I would not want you to cover anything about the strategy, but about your views, perspectives, because you being a very experienced fund manager have seen multiple cycles. How do you see the current macro micro scenario? Do you see the current times opportunistically, or you see there is more pain left in terms of whatever is happening at a global level and how it is linked to India, and FIs have been constantly selling. I'm sure you would have some pulse of why is this that FIs have been consistently selling, and what is kind of coming ahead in this regards.
Sure, I'll try to answer that, Kamal, but let me just preface that with one very important disclaimer, not disclaimer, but just fact. When I was in DSP, we had actually run this exercise of looking back over 20, 25 years at all fund managers, all funds. And, there are three sources of alpha in any in fund management. One is your stock selection, second is your industry selection, and third is your market timing. And if you actually go back and look at everybody, including ourselves, virtually nobody adds value on market timing. Most of the portfolio value, 70% plus, will come from stock selection and something from industry selection. On market timing, almost nobody has generated long-term returns. Yet 90% of the time we spend talking about market and market timing. So with that sort of preface to it, I'd still offer a view, but all to be taken with appropriate doses of salt. The way we see things, I mean, at a very conceptual level, is obviously 6 months ago we've seen a big shift in the whole interest rate cycle. That is very meaningful for equities. Low interest rates and liquidity just provides you a free ride and a good tailwind, and the opposite acts as a headwind when interest rates are rising and liquidity is shrinking. And that's the sort of cycle we're in for now, for some time, till inflation doesn't come down quickly. The good news, of course, is that commodity prices are coming off. But right now it's still a decent headwind. Normally, when you have these sort of headwinds, then you got to, hopefully you start getting a bit greedy in terms of valuations. And you want to make sure that, markets do have a tendency to then sort of derate a little bit into those cycles. It won't happen overnight. It takes its own time, but gradually it does tend to occur. So the way we see things is, we look again at price to book, even from an index point of view, and the very broad boundaries of price to book. So we don't know tops, bottoms, and whatnot, but we do know risk reward boundaries. And what we've observed is, the average long-term price to book for the Indian companies with a overall average ROE of about 14-15% is roughly 3 times price to book. That's almost like a DCF rule of thumb. And the range around that, one standard deviation above 3 times price to book is about 3.8, and one standard deviation below is about 2.3 times. So let's say 2 to 4 is that range, and you've got 3 in the middle. Whenever you've come close to 4 times price to book, the risk reward has been against you. The odds of making money over the next 5 years, you still may end up positive, but your returns are going to be very compromised. Will be much, much lower than how equities is marketed. And if you get the market, closer to the 1 sigma the other way, which is about 2.3 times, 2.4 times price to book, the odds of a positive and above average next 5 year return is much higher. Right now we're sitting right at that center point, which means as a 5 year investor, you still probably do better than fixed income. That's at least what the odds suggest relative to the past. But in this interest rate cycle, we're actually hoping, if you're a long-term investor, you should be actually hoping the market goes down, frankly, because then it gives you opportunity to allocate more capital. But if it does go down towards the 1 sigma on the other side, I think that just keeps improving the odds if it heads anywhere remotely in that direction. So, the idea therefore is, sort of, I guess, keep gradually investing, but keep some powder dry for a slightly more, event where the market, goes to the other extreme and there's more fear on the street. So that's the sort of very broad approach. From a foreign investor perspective, since you pointed out that question, again, the broad sense one gets is that, and this is, being talked about enough, wherein India has outperformed and valuations are much higher than most other places. I think the other thing that a lot of foreign investors are going to appreciate is they're also looking at the currency. The last thing they want to do is take a currency hit. So either the currency weakens a bit, or interest rates rise a bit, or markets are cheaper. I think one of those three conditions have to be met for people to perceive a better risk reward for investing into India. I guess everybody's convinced on the long-term secular story of India, and there's enough interest out there that I'm quite sure of. But it's really a matter of, at what point they feel more comfort in terms of coming in more aggressively. And I think one of these three have to happen for us to see a better foreign flow trend. But, I'll just leave you with one other stat, which is important, which is since 1993, when we opened up for foreign investment, so it's been 29 years. I think we've had a total of negative years, which are totaling only about 5 out of 29. 24 years have been positive flow. So on average, the odds of a positive flow are higher than a negative flow. So even this phenomena will not continue for, there will be a turnaround even in these flows. Let me put it that way, just to summarize that point.
Sure. On this positive note, we would like to now call end to this webinar. Thank you everyone for logging us today. And I would just like to thank Anup. Once again, you made a lot of effort to kind of show up on the camera last week on Friday, but because of technical glitch, you could not do that. But anyhow, we have been able to conclude this webinar very well. Thank you to you as well, Anup, for sparing your time. To everyone, my pleasure. To everyone, I would also like to kind of reiterate and remind that 8th, 9th of July, we have kept, 2 days of a very well-planned event, which has been titled as Summer of 22. Equities are in the air. We know equities are in the air, but kind of when will it rain again, and how to prepare for the same. That is the overall broad, I would say, topic and title for that 2-day of event, where we have more than 27 portfolio managers participating across 10 sessions. And all those 10 sessions in terms of topics have been selected based on the voting from our audience and our client base who wanted to hear about, thoughts, views, and perspectives on all these 9 topics. All of you are most welcome to kind of, join us on 8th and 9th. Keep, watching your email ID where we had sent you this invite. We will be sending you all the more over the next 3 days, 4 days to remind you, and we'll be welcoming. Thank you everyone for logging in today.